Hi, Matt. You cover aerospace credit here at Bloomberg Intelligence, and we just saw Boeing coming up with one of the largest share sales from a public company ever, with 21 billion across common and preferred. So the question to you is, how did we get here?
That's right. It's a necessary move to contend with what Boeing's previous CEO described earlier this year as a tough moment following the door plug blowout on a Max 9 to start the year and fallout that's being exacerbated by a strike of their machinist union that started in September. So with the strike now in its second month, production and deliveries are at a near standstill, and they're contending with plumb last performance for Boeing's bonds relative to peers. So the moment is growing longer and more intense, with cash burn tracking to 14 billion or more for the full year, and usage that's stretching through at least the second quarter of next year, which makes the $21 billion raise vital to keeping cash above their operational needs at about 10 billion, with negotiations on a labor contract with the IAM currently dragging.
Right. So with the labor negotiations dragging and more cash burn that looks unlikely to stop anytime soon, what's at stake here?
Yeah, so the strike's putting at risk Boeing's investment grade standing, with Moody's putting its Baa3 rating on review for downgrade right after results of the strike, which showed an almost perfect plurality of IAM membership rejecting the first labor contract, which offered a 25% wage increase. And S&P had placed their triple B minus ranking on negative watch on October 8th after the walkout approached its 1 month mark. So the second vote saw terms modified to include a 35% wage boost. It increased retirement benefits and a ratification bonus, but was an overture that was ultimately rejected. But I would note that acceptance for terms on a new deal for majority of the membership is critical and important, because those who rejected the deal, it actually fell down to 64%, which we think is an indication that we're getting nearer to the point of acceptance. So currying favor is key to further alleviating fallen angel risk, given the strike is hampering progress in shutting down Boeing's shadow factory, with a stoppage forcing management to conserve cash, cut costs, manage shipments based on inventory levels from supplier to supplier, and supplementing liquidity, which we saw them do by entering into a $25 billion mix shelved. And and the raise is necessary, as the protracted stoppage may push 4Q cash burn to over 4 billion as working capital drags. The timeline for those deliveries gets pushed to the right in inventory build. So the usage could turn positive during the back half of next year, but that remains highly sensitive to the IAM's return to work and the need to stabilize operations in preparation to increase production and deliveries toward the FAA's current production cap of 38 planes per month for the Max.
Right. Okay. So with that in mind, for how long do these actions solve the issue of cash falling below the 10 billion target that you just mentioned? And I guess, like, what happens if it doesn't?
Yeah, so they're raising almost 21 billion in equity in convertible preferreds, which would prevent cash from falling below the $10 billion through at least the second quarter of 2026, and that would help satisfy a near $4 billion spire here in 2Q of 2025, and an even bigger $7 billion tower during the first quarter of 2026. So, without taking the action that they are, the 10.5 billion of cash at quarter end would have fallen about 40% below the OEM's $10 billion target, with which management's comfortable running the business. So commercial airplanes and defense, those are core to Boeing. They're not going anywhere, but Ortberg has flagged some potential asset sales upon conclusion of his ongoing portfolio review, with proceeds from those sales that could act to further supplement cash, with reports of a early stage exploration for the sale of its beleaguered space unit out last week. So to your second point, we recently published a piece highlighting that, if Boeing ultimately proves unable to quell the financial fallout from the walkout, history shows that a full downgrade into junk marks a key delineator for lagging excess returns. So downgrades into the double B tier from triple B shows returns trailing across all sectors. That includes capital goods, of which Boeing is part, turning positive during the first 12 months after becoming high yield. Our data spans about 15 years and indicates angels spend on average about 3 years among the ranks of high yield before some manage to to cross back over. So what we're seeing is Boeing's lagging bond performance this year exhibiting a similar path for potential angels into the downgrade that makes them high yield for index purposes. And so when you look at spreads on their bonds through the belly of the curve, they appear more reflective of these risks, with a little more than 70% of the bonds in their capital structure carrying coupon step provisions, which can soften the impact from downgrades. Each notch is about 25 basis points at Moody's and S&P.
Right. Okay. And where can we find said research, Matt?
You can run it by doing BI space CREDG on the terminal.
Yes, we can. And on your own bio as well. So thank you very much, Matt. That was very helpful. Thank you.
Thank you, Renato. Appreciate it.